Hi, everyone. It is the end of the week. It is the end of, also in my view, the hardships for the week. But yeah, so let's begin with the Awesome 10X Free Friday class with the US market updates, as well as what is happening over in Hong Kong and China. Okay, so sharing a screen today. Look at this. Okay, kita ba? Yeah. Okay, so today's title, US market interim bounce. It is a question mark, but I would argue that the evidence weighs that we are actually near an interim bounce, and China is standing out. So a few things: the S&P 500 index so far has dropped for the last 7 days from the peak of 4,160 7 days straight to about 3,666. Now, what's important with this 7 day drop is that it could go drop another 2 days, i.e., today it can drop and then on Tuesday we finally bottom out. However, my argument is that whether it bottoms out today or on Tuesday, we are actually near a support. So our argument here is that this recent lows of about 3.6 or 3.587 is likely where you'll find support. So watch out for indices finding a bottom within this week. And as you can see from the last 8 weeks before, when we had a gruesome drop, usually even from a charting standpoint, this would be an Elliott wave count. 1, 2, 3, 4, 5. I.e., in the very short term, we're talking about 1 week or less than 5 days, we may actually see a bottom take place. Again, I'm not saying that it's today, Friday. It could be on Tuesday, although it's possible that it's today because today is also options expiry date. We'll discuss those things. Our view is that the Fed has raised rates 75 basis points. The market is shocked, but at the same time, the market has the Fed has done what the market wanted, which was to contain inflation. So you're seeing actually that the VIX always coincided at bottoms during the 35 area where you are today. Your VIX today is trading at 33. Yes, it can go higher at 35, i.e., your indices can retest tonight further lows that might panic sell yet again. However, we are carving out bottoms on the S&P 500 and Nasdaq, so do not worry too much about the US. In our view, it is poised for an interim bottom either tonight or Tuesday, based on the probability that the last few times that the market actually had this fear factor, we're actually close to the bottom. So that was true on the May bottom, wherein you had a tremendous rally the next 3 weeks. And it was also true in March, where we also had a tremendous rally around April. So here and around June 17 or June 20, wherever the exact bottom would be, June 17 is today, or it could be June 21, which is because June 20 is a holiday. But we would argue that we are actually near that interim bottom, wherein you will see another 5 to 10% rally in the index to the upside. So this is your NASDAQ US 100 cash. Your NASDAQ is now seated at 11,250. It is above, your futures is trying to stay above 11,000, although we argue it can still shake out towards these levels about 10.8. 11,250, you may actually see further drops to about 10.8, but do not hyperventilate. Our view is that that would be the last straw or the last capitulation before the markets can proceed higher. These are just really technical bounces, but it is important to view these technical bounces, capitulations as areas of buying or areas to hold your position and not to sell and not to withdraw it to cash and not to short the markets either. At these levels of oversold conditions, you tend to get a strong rally. How ferocious would the rally be? Well, we can see that over the last 7 days, we've dropped from 13,000 to 11,000. That is a 2,000-point drop. In the past, as you could see last March 30, when we topped about 15,000, our final low was about 11.5 in the interim. So that was a 3,500 drop. That took place in 2 months. The difference is that 2 months and the pace of the drop these days is just less than a week. So the drops in magnitude compares to the big drops here where we actually consolidated first before assuming another drop. So while this may not be the actual low, you may actually see more drops by September or August. In the interim, because of the fast-paced drop of 13,000 to 11,000, which is in magnitude form at least 20%, our argument is that percentage form is the same already as the past when the Nasdaq dropped 3,000 level, 3,000 points from 15.2 to 11.5. That was about 3,700 points down. Okay, take note that this Friday, CBOE 2022 options expiration calendar, you'll notice that June 17 tonight is a standard expiration date for equity indices, ETF, ETN options, equity leaps, which will expire in December, January, and June. It is highlighted in red because these events, if you've noticed, are actually the days or the weeks where the market actually trends upward and reverses what was the past. So you can notice that the last time we had that Fed expiry around here, around March 18, you could see that March 15, 16 also was a Fed meeting similar to the June 15, 16, 17. That was 3 months ago. And 3 months ago, we got the huge rally wherein March to April, we actually saw the indices rally. Take note, this is that date. Let's go to that date. This was that date, March 15. Can you see that? From March 15, 16, 17, 18, you're actually rallying towards that options expiry date. Why do you think there was a rally in the first place? Because a lot of people had a lot of put options that they needed to cover. So that was around March 15, which ended in 2 weeks until March 30, April 1. Now, the last time we rallied as well is somewhere here about May 10, May 20s, and we rallied until only around June 6. So let's take a look at this options expiration again. So during March options expiry date, we had a trend reversal until April 1 or until March 31. The last rally we got was also this May 20, which was also an options expiration date. If you'll notice, May 20 until June 6 was a rally. So if you are gonna base it on the fact that options expiry dates usually have a turn, it just didn't happen here in April 14. If we go back to the data, around April 14, the market was simply consolidating here at about 14,000 in NASDAQ. It was at the middle part in an ongoing downtrend. So nowadays, here at about 11,200, you've got the magnitude oversold nature already achieved because of that huge 7-day drop since 12.7, 12.8. Now, the only thing that you are looking at for the next 3 days or the next 2 days is for the rally that happened just like this and just like this. So in the past, in percentage form, let's take a look at the upside. It used to be a 17% rally over in March. Now here, which was more feeble, it was a 12% rally. So let's assume that this one is just a 10% rally. At the very minimum, 11,000 at 10% rally could mean that it could rally to as much as 12,300. So whether the drop would be 11,000 or 10.9 or 10.8, our argument is that this is poised to rebound based on indications of options expiry dates and volatility indices. So you've got bottoms in play in the interim for a bounce. So why exactly in our view does the options expiry date trigger a lot of reversal moves for the next few days? Number one, the argument for the reversal is because a lot of people right now are holding put options. That means that they've held put options on the S&P 500, on the Nasdaq, on the Dow Jones. And on an options expiry date, either they will roll it over, i.e., if they were going to roll it over, they have to short at these levels, or if they don't wish to short at these levels, they've got to cover. And in our view, because it is highly oversold, the view is that most of these short positions would cover, and the covering will trigger that rally in the interim at least until June 30. So we are expecting this bear market rally to be at least a 10% move to the upside from 11,000 to 12,300, and then wait again whether on July 15 another Fed rate hike for another big drop. We can even rally from June 17 all the way to July 15, and that is a tradable rebound in our view. So take note, in my view, all of the dates when it comes to options expiry. Now, June 16 last night, we also saw the market drop because that was the last day to trade expiring standard American settled equity index options. So that means that for everyone who was not really gonna exercise, that means that they've let it expire. So those expired in the money. We view that almost all the options today are situated in the short side. And because 95, I think the put ratios are huge in the market. I think it's about 80 to 90% in the put side. Because it is highly skewed to the shorts, my view is that you tend to get all of these shorts to get covering within this last day. So June 17, June 16, these last days and expiration dates would trigger a big reversal move. This was true not just in June, but also in January and also in December. So does this theory play out in general? And this is one of those indices, example here. And actually, in every Fed meeting that has transpired in the market, it usually became a short-term bottom, even in the February areas here and even in the January areas here. So you'll notice that all of them usually coincide with an options expiry calendar. Due to the nature of most people trading options, we ascribe to the view that end of the month, every month, has become also a reversal date. Either the market will stop rallying or stop going down. Okay, so that means a potential top is about June 30 or July 14 with the next Fed meeting or the next options expiry date, which means that you've got about 2 weeks to actually rally. Take note that June 20 is also a holiday. So because that is a holiday, there will be more reasons for these people who wants to close and take profit to really close it. Closing their profits means that for those who bought puts, they gotta sell puts. And if they're selling puts, that triggers your rally today. Okay, so so far, these are the inverse funds. And you could see that the volatility, short-term futures UVXY, is now down 3%. Your inverse fund in the NASDAQ, which is triple levered like SQQQ, which has rallied another 11% last night, almost near all-time 52-week highs, is now dropping 3%. We are seeing signs of this short covering action already in the inverse funds. These are all your inverse funds from the Dow Jones to the NASDAQs, and it differs if it's a triple lever or a double lever fund or even just the Russell 2000. So we're seeing that they're all getting short covered, which really coincides with our view that the market is in a short covering in an interim bounce, even in the very short term. Well, not even in the very short term. In the very short term, we're talking about just 1, 2, 3 days. In fact, we're guessing that the bottom is tonight on the options expiry date or on Tuesday. Okay, so the market has extended to the downside, and therefore the VIX gives us the probability for a reversal move. And take note, if you wanted to see how far the ETFs have gone down in terms of being oversold, okay, so we are seeing actually a full-fledged sell-off in the last week again. The semiconductor bulls or the SOXL has been dropping the largest. You could see that this 3X is triple levered, meaning it fell 27% for the week, and it fell 18% last night and 35% for the month, 80% down year to date. So the semiconductor or the SOXX has become one of the most oversold names to take a look at. And you can see that there are only 2 funds that are up for the month. Amongst the ETFs that are not inverse funds, it's just the Invesco Solar Fund, that would be the TAN, and the Chinese Internet Fund, i.e., if we are looking to buy stocks on a 3-year perspective, the Invesco Solars are still up for the last 3 years, 130%. The Chinese Internet Funds, which were down 50% at least year on year, are now actually recovering, and we will take a look at those. That's why in our title, we said, do we see China market decoupling? Now, you'll notice as well that most of the indices last night dropped at least 5% from your mobile payments. That would be all your fintech, from your esports related entertainment, video gaming funds, your semiconductor related to 5G, all of them are falling 4%. Your IGV related to anything in the software related names such as the Atlassian or the Twilio, at least a 4% drop. Even in cybersecurity was falling 3%. Even your Vanguard high dividend yield. So in terms of drops, I would have to show to you the movement in these past weeks is actually considered a standard deviation. And it's worthwhile to actually check these charts when we are looking to buy on an oversold bounce in the interim. So I'm looking mostly in the semiconductor and the solars and the Chinese internet, just these four, although a little bit also in the mobile payments. Now, this is also an interesting stat. I got this from Ron Walker, so you can just check. He's a chart pattern trader. He noted that when you go down in the index more than 1% 4 days in a row, which was happening this week, the S&P 500 index since 1950s have resulted in the next 3 months, 6 months, 12 months into a sizable rebound. In 1962, although there were drops in the 8%, 6%, 12 months after was 12.5%. Now, there were also instances in 1962 where it actually already became the bottom. 1987, it was a short-term rebound for the next 3, 6, 12 months. In the year 2002, which was also a bear market. In the 2008 financial crisis, the ultimate streak was a 7-day consecutive drop. So that was an amazing drop. But after that, you did get that 6% rally 12 months after. In 2009 crisis, once you got that 4 consecutive day ultimate streak drop, it was an amazing 30, 40, 50% rally. In 2015, 2018, almost all were registering great gains. So now the question is, as of June 13, the ultimate streak, which is so far 4, are we going to get a good sizable bounce in the next 3 months, 6 months, 12 months? So why is it since June 13, we're talking about this drop? So June 13 was Monday. Actually, Thursday, sorry. We dropped on Thursday here, June 9, June 10. Then we got the June 13. So 1, 2, 3. We rallied, we started to rally a bit, then fell again another more than 1%. So 1, 2, 3, 4, big 4 drops. It didn't really go like, ito lang yung 4 consecutive days. 1, June 8, June 9, June 10, June 13. So those were 4 days, and then followed by another big down streak last night, which was also more than 3%. So these drops are specifically rare. So it is notable to see that those drops are akin to find a strong bottoming out in the next few days, which coincides with saying that you have to be bullish even when the entire world is talking about getting out of the market. At these levels, even in the short term, you do have a chance to bottom here at 11K, and 11.2 can actually rally straight towards 12,000 in the next week or so. Let's take a look further on charts. As for the Chinese markets, as I said, for the month, this is the ETF China market has actually turned the corner. A lot of other analysts would say about the valuations. You can watch these Bloomberg videos yourself. Chinese markets have turned the corner. Let's just watch one.
We are seeing a policy divergence between the Federal Reserve, the BOJ, the PBOC as well. What are you watching closely to sort of gauge where the potential opportunities could be?
Yes, absolutely. I think the reason we like China the most is because it has just gone through a legitimate and pretty deep recession that it's coming out of, right? The process of exiting that recession recovery is going to be kind of bumpy because of external concerns such as what you've been covering all morning, and because of lingering COVID control policies, risks with that. So it's going to be a bumpy road, but I think China has turned the corner, and I think that's the key opportunity for us in the second half, when we're likely to see global volatility still elevated.
Can you also play the divergence between the Federal Reserve and the BOJ? We have seen a very weak yen, but even weak yen beneficiaries haven't done that well.
this is true, right? I mean, the Japanese equities, that's supposed to be the weekend beneficiary, but no, at the moment, it's, well, I mean, this has all been driven by movements in the US yield, and the BOJ has done all they can to keep its yield curve control policy in place. So I think the question really is, one, will Kuroda be able to maintain his policy? And it sounds like he wants to. And two, when will U.S. yields roll over and begin to come down? And I think that's obviously a function of inflation as well. So there's a lot of moving parts here.
Okay, we'll stop right there. He talked about Chinese yen, Chinese yuan. Let's talk about Chinese yuan and the dollar yen. So you can see here that the dollar has been strong over the last few weeks. Since April here, the Chinese yuan has been devaluing from about 6.4 to 6.7 here. You can also see the same thing happening worldwide, wherein the dollar or the currency dollar has been strengthening all throughout the year. Wait up. Let's go there. DXY, the dollar index. No worries. Let's just go through the Japanese yen here. The Japanese yen is trading at 134. So you can see that these are all-time weak yen status. So weak yen, that means that there's actually cheap yen that can actually pay for liquidity in the sense that since the Japanese government is actually in an easing moment versus US, which is in the tightening zone. A lot of people believe that a weak Japanese yen is going to help that economy. Same as for the Chinese yuan, which is also weaker than the dollar. For its exports. So and they could export most of their products for America at a cheap rate. So those would help in terms of inflation because that is a disinflationary tool. What this means is that if you could import a lot of Japanese goods and you are earning in dollars, then in this year alone, you could see that the valuation is helpful for you as a huge discount to buy Japanese goods or Chinese goods. He also mentioned that Chinese markets are turning the corner because it is also the first to actually be in a recession and a deep recession at that in the last few years, actually more than 2 years already. A lot of people are discussing whether it be Goldman Sachs, Morningstar versus over. You can watch it yourselves. But I'm going to go through a lot of charts. Do these analysts and their clients, do they actually do what they are saying? And the answer is yes. You are seeing actually diverging paths. So far, Chinese local stocks have already outperformed US shares in the last month, wherein the Shanghai index, you could see in 2022, has rallied over the last 6 months to about 8%, whereas over the last 6 months, you are also aware that nothing good happened in the US except to continue falling down. Those divergent paths are important to notice. In essence, let me show to you the same thing here in the chart of the US-China A-shares ETF. Look at this chart. The US-China A-shares here has been diverging from April 25 all the way now to June, July, almost June, wherein it's rallying in a year where that time frame, most of the stocks in US have been collapsing more than 20, 30, 50%, depending on which issues. That divergent path could be attributed, obviously, to the version of quantitative easing of China versus what's been happening in US. So let me read through a few of these. On April 6, the People's Bank of China consolidated a raft of administrative decrees put in place to manage risk to the Chinese financial sector. In this provision, they set up a financial stability fund enjoying liquidity support from the PBOC to diffuse all the financial risks. Consequently, at that moment, the Fed has been shrinking their balance sheet, which is the QT, quantitative tightening, while the PBOC is gearing up to implement their own version of QE, using their own balance sheet to support the financial sector and the economy. Take note that China has more than $1 trillion of GDP a year, and their balance sheet is double the size versus USA. The policy divergence between the two major central banks have huge implications for growth prospects of both countries, as well as international capital market flows, especially emerging markets. Going forward, and I read this to you, written by Hong Tran, it is important to keep in mind that the economic fallout from the war in Ukraine persists, but China has ample policy space to support growth compared to US. China's growth has been revised downward, but is still targeted at 5.5%. By contrast, US has been cut to 3%, if not a negative, for this whole year. So several economists are saying a recession will not be avoided in the US because the Fed will obviously have to raise rates more forcefully. And you've got that 75 basis points so far and another 75 basis points next July. And the question mark is on September, whether it's too fast or too much for the economy to handle. So what you're seeing here is that the government debt of China versus US stands at 130% of GDP for US, and compared with that of China, which is just 72%. So PBOC's balance sheet more than doubled since 2008 crisis versus the Fed, which has ballooned by 10 times. So that divergence means that in the prospect of stagflation, i.e. low growth economy, it looks like more of the flows are posited to go towards China, or probably if they're leaving the US markets, they're likely hiding in some Chinese assets here. We're going to show to you that the country's central bank has signaled that they could also reduce interest rates and reserve requirement ratios over the rest of the year as a spillover effect of tightening by the US Federal Reserves. Fed officials are prepared, of course, to move 75 basis points just to tame inflation. And the space for China to reduce rates may actually expand as needed to control. Also, recently, you know about China issuing a lot of green bonds, which is really supportive of solar, and that's the reason why, as a sector, we are very bullish on the solar, and that's why we were also showing that the Chinese solar-related names may be actually companies that you want to take in to your account, to your portfolios. China continues with a monetary easing policy, which makes for an ideal debt issuing environment. Green bond sales are expected to rise as the world's second biggest economy diverges from the rest of the world, continuing to ease monetary conditions to spur economic growth. We know that Xi Jinping has approved a $2 to $5 trillion plan to save the world in terms of climate change. And that is also in conjunction with Biden's G7 World Infrastructure Fund that he is releasing, and he plans to issue to combat China in terms of the climate change race. In other words, with these two countries doing their best to basically have big packages for this environment, I'd say that you want your portfolio to be positioned to where the money flows are headed towards. And you can see that in terms of Chinese issues, although last night there were some drops, in comparison, actually, those daily drops last night are mitigated by the extended hours rally today already in Chinese issues. And if you look at the Chinese issues for a month to month, the Chinese issues are all at higher lows. So let me show to you just how strong Chinese issues are and why we believe that this is where most of the majority are parking their money. Okay, so for the week, actually for the month, we are seeing New Oriental Education and Tech already rallying 95%. DD Global for the month was up 77%. In fact, year-to-date, Edu or New Oriental is already up 5%. You're seeing Pintuotuo after very good earnings up 50% for the month and 1% up year-to-date. Last night's drop of 2% pales into comparison with the big monthly gain. The fact that some Chinese issues are now actually headed to a positive year-to-date gain tells me that there is much to be had in terms of a potential bullish movement in China. And it makes sense because China has been in a bear market for more than 2 years, since 2021. Actually, some issues since November 2020. So that's the reason why this could have been a faster, although bumpy ride, due to the fact that this was 1 year early in the bear, it's also going to be 1 year early in the bull side. So by June 2022, perhaps for US, it's June 2023, you get a 1 year head start for a potential bullish bumpy ride to the upside, courtesy of China. So you're seeing the rallies of Futu 30%, Li Auto 30%, Nayuki Holdings, which is a milk tea 30%, Kingsoft Cloud 30%, Great Wall Motors 28%, Wuxi, which is something like a biotech firm in China 26%, Billy 25% up, JD 23% up, Neo 20% up. So these strength, even in their own TikTok, Kuaishou, they're 20% up as well. Alibaba 16% up. So we are really seeing that there is a strong reversal happening in Chinese issues, and something to watch out upon. In fact, we're going to show to you a lot of charts in Chinese issues, because my view is that we do have a potential bottom in place. Chinese education names are 200 to 300% from Lowe's, Talent Edu. You saw me share that the divergent paths of China is happening. Let me show to you the exact chart of those Talent Edu. Here, well, that's true as well for the cars. Okay, looking at the charts here, the TAL here since March has been rallying in higher lows without a significant news flow. So my sense is that TAL and Edu are rising based on short covering and actual PBOC easing. So the market around this time, April, since the announcement of quantitative easing, has been showing that divergent path in the sense that it is actually being bought up in a bullish sense. So this is $1.60 rallying to 480, could potentially drop back to $3, but as you can see, a $3 drop is now going to be seen as a higher low for TAL. Same thing here for New Oriental Education. We are seeing that rally from about 10 to 22 also around April time. So that has been true here as well. I'm seeing cars. We've gotten EV subsidies. So in terms of the Chinese cars, the government has released EV subsidies for rural and for city urban people who would buy any EVs. As much as 15.5 billion yuan has already been approved, which translates to at least 4,000 to 5,000 yuan to help the consumers purchase a Chinese car. This is also helping companies, most especially the ones who are in the EV space. So we're seeing Xpeng. Since I think the release was around May, you realize that on June 1, Shanghai already reopened. So most of the factories in Shanghai reopened. And that coincided with the start of the rally of Xpeng. Around June 1, we saw Xpeng rally from 78.50 to 106. And in my view, after a volatile rebound like this, any drops back to 90 or 100 is being bought for Xpeng to potentially rally to 120. And although there will still be resistances there, eventually you might actually see higher lows the way that you've seen in TAL and Edu, because TAL and Edu are more advanced in terms of short covering. The Chinese cars have been happening not on April, but actually now around June. Perhaps it's the EV subsidies and the resumption of the manufacturing factories of all of the cars. So as I said, the solars are the ones that are getting a lot of movement on the upside. And the charts are also sharing that very clearly. GCL or 3800 HK here has been consolidating over the last few months of 2022, whereas every other company were falling down. We know that the solar panels, the cheapest, come from China. And so GCL was actually just consolidating here at $2.50, $2 area. Once the market already deleted the tariff duties between Chinese solar panels towards US, you saw that break above that 250 with a resounding volume, actually at a 260, 270, and is now in a flag zone at 320. We think the GCL then goes to about 350 and then hits all-time high. So those are actually some positive movements. And that is not just true for 3800. We are seeing that in Jinko Solar, which is trading in the US. You could see that Jinko Solar, just like 3800, has consolidated here, which is very strong, stock specific, very strong, above higher lows year on year with 27, 38, 53, a far cry from every other solar panel that is not a Chinese company. So you'll notice that companies like CSIQ, which is Canadian Solar, this is not as strong versus GCL or Jinko Solar. In my view, is that the reason why it has not been so strong has been due to the fact that Canadian Solar obviously is not tied up with China. They are not as close, no. So there might be more difficulty. Then again, the truth of the matter is that they are all actually hinting of higher moves. You can see that with Invesco Solar ETF, which is investing a lot with solar firms. This year, Invesco Solar is still up year to date. So you're seeing that from 58, it rallied to 79, dropped back to 58, rallied back to 79, and nowadays it's dropping to 66. But my argument is that it drops near 60 or 58, that is still a buy, and it might actually be trading in a range because there's a lot of volatility in other solar firms. It's become a trading range, a huge trading range, but it is very clear to me that the Chinese solar firms are stronger versus the overall solar firms of America. It makes sense because the overall solar firms only released the solar panel duties to be deleted only around a few weeks ago. So Joe Biden signed the tariff a few weeks ago, even when a few months ago it was already being discussed by economic advisors. So that actually resulted in this strong movement of Solar Edge. When that news happened, Solar Edge was able to rally from 200 to 320, albeit it's dropping now. But as I said, I do see the strength of the solar firms in comparison to the U.S. market indices. We are seeing that strength in Solar Edge and Enphase as a sector and as a group over this year. So we've been seeing actually that this has just traded in a relative trading range wherein your support is 130 and your resistance is 220. And that is pretty strong over the last 3-4 years, because you can see that Enphase, especially during the pandemic, was just trading at 39 and 40 areas. So you can see that that is still a growth stock that has been strength and that has been supported by the technicals and fundamentals. So solars have been a relative safe haven in this marketplace. GCL has done well. There's a little bit of confusion by others why 968 or Sydney Solar isn't moving as strongly as 3800. But my sense is that it's just probably a pricing mechanism. It's a little bit weird, but Sydney Solar has been getting as well a lot of orders actually. So my sense is that this could be just a patience play. But we are generally bullish on most solar names, whether it be 968. But from a technical standpoint, of course, 3800 is stronger. And we mentioned a while ago XPeng, but from a charting perspective, 2015 and 1211 are our preferred momentum charts. As you can see, Li Auto has been delivering stronger than expected auto sales. We already got the month-on-month delivery numbers. The May sales were very good for China, in particular, mostly for Li Auto. So Li Auto has been leading the pack, and then XPeng, and then lastly Neo. And actually 1211 has been doing most of the heavy lifting when it comes to Chinese EVs, which is why it shouldn't surprise anyone looking at the auto manufacturing data on why 1211 is actually nearing a potential all-time high move. Yes, you heard me right, a potential all-time high move even in a bear market in China. So you can see that Hang Seng Index and A shares are not in all-time highs. And they are, however, recovering. This is the Chinese A-share market starting to rev up since April. You've got the Hang Seng Index also revving up since around March to April. So we are already seeing that strong move, and we know what was the result. It was due to the easing of crackdown, and that has been true not just for not just for Hang Seng, but you could see that since March there was this strong jump on Alibaba from 88 to 120. Yes, there was a retest around April and May here at the same levels of 85 and has subsequently rallied back to 120. So in our view, we are actually forming a bottoming out phase here in Alibaba, wherein 80 or 90 is already getting swarmed by a ton of bargain hunting buyers. And we are actually poised to go back to 120 and 150. So be acknowledging that we are actually coming out of a bear market already from China, and we are actually already headed towards a potential 150 move. And more short covering could take it towards 175. So it is a process. It might not take in a week. It might take 3 months or 6 months or even 12 months. But we are seeing a potential movement higher. And so dips in Chinese names like Alibaba is a buy. Take note that JD and Pintuotuo also are doing the same. And JD actually being stronger in a technical fashion. JD here from 42 to 48 and now trading at 62. And 62 is actually just off a few notches from its highs of $100. So from a technical sense, Alibaba is more undervalued. Fundamentally, Alibaba is more undervalued, but the market likes JD in the technical sense. The momentum and the lack of resistance of JD might actually tempt other people to get more JD rather than Alibaba. JD is dual listed 9618 HK. So you're already seeing that the delisting fears are gone. We have seen DD is now trading at the OTC market, but is also up already 100% from its, mga 70-80% from its low of 1.4. So 1.4 rallied to $3, dropped to 230, but still remains on the uptick. So I made a thread here of a lot of companies that are actually moving on the upside. So we talked about 1211, so Chinese cars. I'm also showing to you that the reopening of the Chinese economy on June was very helpful for milk tea brands. So Nayuki is a milk tea brand, very famous in China. They've got a lot of stores. If you're fond of drinking milk tea, you must have known about Nayuki. So Nayuki's sales are, of course, expected to rally upon the reopening of the economy when people go out after the zero COVID lockdown. So we're seeing that rally from $4 to about $6. That's a 50% rally in just a few days. My sense is that there was a strong consolidation and accumulation here. So this is already reversing up. It's not just Nayuki. It is also true for Haidi Lao, which is one of the casual hot pot chain shops in China. You're seeing that rally from about 10 to 15. We're also seeing the same happen for Yum China, which is the fast food group of KFC in China, the owner of KFC and Pizza Hut. So since March and this June, we are actually seeing a bottoming out phase in Yum China here at 38, negating the listing fears. All right. So the fact that even DD is just in the OTC market doesn't mean that any American cannot trade these names, and the delisting fears are not really as huge of a problem, as you can see that the accounting and transparency of these Chinese firms are willing to be scrutinized. So I would say that there's a lot of buyers actually in here 38, 39, and Yum China hitting near support might be an actual buying zone for people who wants to take a position. In fact, China, I would argue, Li Auto, any drops back to about $30 here might actually be an impetus to buy, to get a strong mover in terms of sales for Chinese vehicles. Of course, if we're bullish on XPEV, NIO, Li Auto, NIO also showing that bullish movement now. So we are already exiting that downtrend, and with a lot of product launches in NIO that was released this June 14, that actually was the reason why the downturn was negated. The downturn was due to the earnings ballooning 4x, But with positive feedback on their vehicles, the new models, it looks like it got eaten up, and the market is willing to actually buy NEO anywhere from about $18 below. So and a break of 20 actually opens it up to as high as 26. So very strong movement in my view for Chinese issues. Be watchful. We're seeing a lot of reversal plays. Mini saw, this is very important. I've seen a strong mini saw buyer this week, and to clearly show that to you, important to take a look at the volume. So you could see that over the last few days, mini saw rallied from $5 to $7 and had a strong volume. Yes, you heard me right. That is a 40% increase in a day. And we are seeing some tremendous movements actually in Hong Kong issues. We've seen how the GME version of China is Koolearn, wherein it rallied from $4 to $30 in just 1, 2, 3, 4, 5, 6, 7 days. So yes, there's already a profit-taking move after that. But the point here is that if companies like Tal, Edu, and Koolearn, all these Chinese education stocks are rallying based on a sentiment turn and a short covering turn, I would argue that even these companies like Miniso here about $5 is likely to also be doing some amazing rebounds over the next few days. So that 5, 6 area might actually rally back to 9 or 10. So be watchful of Chinese issues today. Low risk, high rewards. Kings of Cloud also happening. Kings of Cloud at 3 areas. So Kings of Cloud is the owner of similar nature for Alibaba Cloud, Kings of Games, right? So Kings of Cloud used to be the partner of TikTok, ByteDance. So they still have a lot of partners in China, and my guess is that if you're bullish on the cloud security firm, you are actually seeing quite a lot of buyers within the 3 to 4 areas. So the setups here look to me quite suggestive of a potential buy. Kings of Cloud owner is supporter is Lei Jun, also the owner of Xiaomi. So 1810 HK, let's take a look at that. Xiaomi also showing some bottoming out phases here at $11. So something to watch out from when everyone in the world is talking about a bearish Chinese issue. It looks like they've actually reached bottom and is actually poised for a rebound up. So the last time Xiaomi was 11 was somewhere around 2019 to 2020 pandemic. And it actually rallied from 11 to 36. If we're coming out of a potential bear market in China because of the monetary easing and printing of money, you might actually see some rally going forward. Of course, we're very bullish on Pinduoduo. Look at small cap issues. You'll see that they are in a bottoming out phase. Almost all of them. Agora is actually sitting in a very low risk reward. Very low risk but potentially high reward area. So you want to be watching these as accumulation areas. Suddenly, Agora at $6 can instantly go 9 or 10 or even 12. So you want to be putting a few buys here in Chinese issues. Agora is the one that is handling a lot of live streaming for Clubhouse. Not just that, but many games as well. Douyu is trading below cash. So at $1, I think that a lot of people, even their own management, has been seen buying as early as $2. So 1 going to 2 is not unlikely. 2 going to 3 or 4 is also possible. So watch out for Douyu. This could be actually already being accumulated. Pinduoduo, as I said, has been reversing upward. Pinduoduo managed to have very good earnings. That's why in the recent report, from 40, it rallied straight another 50% up to 60. The recent low of about $32, I doubt you can get it. And around March, Pinduoduo traded as low as 22 because due to the fears of the listing, which never really transpired. So Pinduoduo, in my view, is one of those names that China really has been supportive upon. And yes, you heard me right. 22 has rallied towards 60. Yes, that has gone almost 300% from its March lows. So any drops of Pinduoduo back to about $50 or 49 is actually perhaps more in the condition of a buying area and buy the dip. So if you are a person who loves buying the dip, you want to buy the dip in an uptrend. and Pintuotuo in Chinese names looks to be the companies that you should be buying the dips for, because these are the ones that are in a reversal to the upward trend. You couldn't buy the dip when it's on a downtrend, but if it's in an uptrend, now you can start buying the dip. Okay, so that's true for Chinese issues, Alibaba, Pintuotuo, JD. Also, I will have to share that as for cryptocurrency, a news that you would have seen today is a lot of of course, there is a merge in Ethereum, which means that ETH miners will now have to find other use cases for their rigs, because that means that Ethereum will not be needing proof of work, but will just be a proof of stake. I.e., if you have a lot of Ethereum at stake, you can actually be the blockchain miner, and you can be receiving Ethereum for that. So far, we are seeing that Ethereum is currently high volumes here at about $1,000, reminiscent to what happened during the past year at $2,000. So whether 1,000 area or $900 remains to be supportive is actually dependent on whether the Nasdaq starts pushing themselves up, no? So we've seen how Ethereum getting a merger around 3 months ago, around 3 months next, by Q3 is actually positive in my view, because that means that the less mining involved, everyone who would want to earn Ethereum would just simply need to buy Ethereum and be a validator and a staker. So a lot of Ethereum, a lot of miners today are of course very cognizant of climate change. It is actually good for the world to support the chain that will continue without destroying Mother Earth. No, so this is good for me. The proof of stake is a good function for Ethereum rather than proof of work. And here at about $950 or $1,000, we do see that potential to be the support. Now, why would it hit 950 or 960 only if 11,000 Nasdaq breaks? So if 11,000 Nasdaq doesn't break, then you will just see Ethereum trade above 1,000 and probably rally back to 1.4, which is, you heard me right, 40% higher. So these are amazing risk reward areas, and we are discussing that in the interim, we do see a potential bounce, and China is truly standing out. With that, let's just quickly go through. Let's just quickly go through a few things, like a few sectors, and opine something about them. Okay, so amongst the companies that have been getting supported other than China, it is interesting to also show to you the charts of semiconductors, as I said. So let's go through that. So semiconductor bulls have really dropped way too much last night. It was dropping 18%. You've seen how, of course, Soxel is more volatile because this is triple levered. But over the last 7 days, this has gone from 24 Soxel to 13. So actually, even a 10% drop to about $12 would necessitate this one to rebound due to an oversold condition. So this becomes one of our buying zones for semiconductor longs. Now, why do you think that SOXL has been dropping? Okay, SOXL is really a triple levered fund of NVIDIA, AMD, Qualcomm, which are actually, in our view, chances to buy in this market dip. So you'll see that NVIDIA from about $340 has already dropped 50% since November, here at about $160, even when NVIDIA's forecasts continue to remain actually bright. Same thing actually for AMD and Qualcomm. So AMD has dropped from 160, 50% down towards 80. You're seeing Qualcomm also nearing 200 before, now down to about 115, with a lot of buybacks here at about 115. So that is an interesting stock to pick up, in my view, amongst the potential issues that you want to watch for oversold interim rebounds. Either you buy an AMD, an NVIDIA, or a Qualcomm, or you simply just buy the index, which is SOXL, which is a triple levered fund. And you could see that the 12 areas are actually near those areas of June 2020. Of course, if you do not like a levered fund, you can just look at the semiconductor ETF, which is SOXX, which is also at those capitalization areas already. So at 350, even as it can fall to about 325, my argument is that you're already at the lows, especially after those knife drops over the last 7 to 8 days. So these drops from about 420 all the way to 350 suggest to me a panic selling mode that is really capitulation, similar to what happened here, here, here. And usually when you get a lot of capitulation, you do get a lot of rallies, especially if it's a consecutive drop like this. Notice the next few days or the next few weeks after, you do get some rebounds. So we expect a rebound, even at the very least, just 10%. Stock sell is a one to watch. Solars are the other one to watch. Now, as for the uraniums, so far, the uraniums aren't showing to me any signs of a bottom yet, although we are bullish simply because of the fundamentals. So I'm not sure if 19 here are going to rally already, but the happy thing for the uranium bulls out there is that we're actually still in a shortage, and the drops here of uranium is actually perhaps an entry point. So I'm still bullish on uranium. It is part of my longs, just like Chinese issues now. I'm going to be long on most likely 1211. And I'm so far long 1211, 3800. I will try my best to get some Chinese cars like 2015 on dips. So these are entry points for me, Li Auto, on dips. The strength is something to behold. So we'll watch these Chinese entities. Yeah, so thank you guys for watching. Let me answer the question there. Are you not afraid of the Communist Party of China? The Chinese Communist Party is the CCP. And I understand that there has been risks. That's why a lot of people have told that China is uninvestable. So my view, though, is that those risks have truly been a matter of, I guess it is a matter of your risk allocation. If we're gonna just view this strictly on money flows, technicals and fundamentals would tell you that Alibaba, JD, and Pinduoduo had nothing to do with any human rights allegations of China. I mean, a company like Tencent or these entities that we are discussing, like a Miniso, isn't supposed to just be, what a company does and what a country does is not the same. It's almost like saying that if you don't like the government of China, does it mean that you can never invest in Yum China? Yum China, which just operates KFC and Pizza Hut in China. I disagree with that. In fact, Coca-Cola, Tesla, Apple, Tesla itself is invested in Shanghai factory. Apple supply chain is obviously all in China, although they've been diversifying in Vietnam recently and Indonesia. I argue that the world cannot actually afford to the world cannot really afford not to invest in China. That's me. But of course, I respect other people's views if they deem the risks of CCP's human rights allegations to be the cause for them to shy out from China. I think everyone who is against investing in China isn't talking about the fundamentals or the technicals. Mostly they're talking about human rights violations, and they just really dislike the government. So it's a matter of whether you don't like a regime, an authoritarian regime. But to me, the accomplishments of China is reason enough for me to believe that their government will support capitalistic businesses, and therefore the shareholders will get their appropriate rewards. Well, there is already a discount. If people would argue the valuations of Chinese issues, we're talking about Alibaba, which went more than 500% growth in revenues over the last 8 to 10 years. And yet the stock price is actually just the same as 2014, even less than 2014. So when we compare Chinese big tech, the Chinese FANGs group, it has priced in all the negativity. And to be honest, Alibaba should be not trading at $290 billion, which is trading today. I think Alibaba's trading 250 billion now. Let me see. Or is it 200 billion? Basically, it's like trading not even a trillion company, right? So you really have a lot of undervaluation already baked in terms of, oh, sorry, it's 275 billion. Yeah, so it used to even trade just like $200 billion, no? We've got tremendous undervaluation today in most Chinese issues, especially if you'll ask me, Miniso. I saw companies trading at below cash. Yatsen Global and Douyu are trading below cash, like 50% below cash. Let's show that to you. Yatsen Global's cash, which is a business that wouldn't actually be bankrupt within the next week. The market cap is 368 million. Their cash per share is 96 cents. Even if they're losing 200 million, as you can see, again, their cash per share is 96 cents. And you can see that the company today is at 75 cents. No wonder it rallied from 50 to 75 cents. Another company I will show to you is Douyu. The cash per share of Douyu is more than what the current price is. Douyu is currently at $1. Okay, they didn't write here the cash per share. Says here that the book value per share is 2.8. Again, when a company is trading below book value and has zero debt and zero equity, and the market cap is 300 million, and yet the sales are 1.3 billion and has a path to profitability, in this case, live streaming, I would be skeptical about all the bears. The bears are selling most of these assets at below liquidation point. That is the reason why TAL and Edu went up 300% in the first place. Because when they were rendered as impossible to make a profit, when the Chinese issues, when the Chinese companies said that they cannot operate as a profitable organization, that they have to give education for free, they had to change their business model to doing e-commerce and doing live stream education so that they can earn some advertising from their education. In some ways, I think that the TAL and the Edu are doing imaginative, how should I say this? It went up because of short covering, but you cannot argue why these big firms, these online education firms, would have to think how they could make money eventually, right? So that's the reason why TAL, Edu, 1797, they're now becoming e-commerce live streaming firms. So from trying to teach education in school, now they're just doing YouTube education for Chinese firms. I don't know, maybe in the next few months, maybe China will implement more ideas for these education firms to make money. But that's China. I think for China, we have to live by their rules. And when we trade China, I agree, understand the resistances. So I'm not saying that Alibaba's just going to go shoot to the moon. 120, 150, you've got several sellers. But $90, $80 doesn't seem like you've got a ton of sellers. In fact, you've got more extreme buyers there. And a lot of bargain hunters in Miniso, a lot of bargain hunters right now in Agora. And Agora isn't a Chinese company. Agora is working with games. Any company that is making an SDK, software development kit, programming their games with the live streaming function like Discord, it uses Agora, whether it's whether they are using Agora or they're but I think a lot of them use Agora, actually, API. So something to watch out upon. When everyone is bearish, you have to always think it's becoming lazy to be a bear, to be honest. Everyone is talking about recession. Everyone's talking about depression, stagflation. And you ask yourself, does this company actually lose money? Or does this company actually make money? And when you ask those relevant questions, you begin to answer yourself, Disney is not going away. At $90, this is where 5-year lows exist. And Disney, no matter how negative everyone is about the lack of streaming subscribers in Netflix, isn't really gonna go to zero. So I am actually deploying some cash towards Disney. I'm actually deploying some cash towards Apple and Amazon. And I am also bullish in China, most especially. So thanks for watching, and I'm happy to share thoughts and see you again. Hope that you guys like the channel, and please don't forget to subscribe and like so that more algorithms can find Awesome 10x. We do this free Friday class also every Friday. So yun, that's it. Thank you very much, and see you again.